What if one of the most interesting fintech stocks of 2026 isn't actually a bank? What if it's something much bigger? A company trying to combine digital banking, lending, investing, financial technology, and financial infrastructure into one growing ecosystem. That's the SoFi story. And here's what makes SoFi stock so interesting right now. SoFi isn't trying to compete with traditional banks by simply offering another checking account. It's trying to change how people interact with their entire financial life. And if that strategy works, SoFi could become far more valuable than its current business suggests. But there's a problem. The stock market already knows SoFi is growing. Investors already know the company has millions of members. They already know Fintech is expanding. So the real question isn't whether SoFi is an interesting company. The real question is whether SoFi stock can still deliver attractive returns from today's valuation. And that's where things get much more interesting. 1. What exactly is SoFi building? SoFi began with a relatively simple idea. Use technology to make financial services easier, faster, and more accessible. The company originally became known for student lending. But SoFi didn't stop there. It expanded into personal loans, mortgages, investing, banking, credit cards, financial management, and other digital services. Today, the bigger strategy is clear. SoFi wants to become a financial ecosystem. Think about your own financial life. You might have one company handling your checking account, another handling investments, another providing credit, another managing your savings, another handling your loans. SoFi wants to bring many of those relationships under one digital roof. And that creates a potentially powerful advantage. Because once a customer is inside the ecosystem, SoFi has opportunities to offer additional products. That brings us to one of the most important concepts behind the SoFi stock story. 2. The power of cross-selling. Imagine someone opens a SoFi account because they want a high-yield savings product. That's only the beginning. That customer could potentially use direct deposit. Then they might start investing. Later, they could apply for a personal loan. They could use a credit card. They could use other financial services. Each additional product can potentially increase the value of that customer. This is extremely important. SoFi doesn't necessarily need every customer to become wealthy. It needs customers to become increasingly engaged. The more financial products a customer uses, the more valuable the relationship can become. And that's one reason investors pay close attention to SoFi's member growth and product adoption. But there is another part of the business that many casual investors don't fully appreciate. And it could become one of the most important pieces of the long-term story. 3. The hidden technology business. SoFi isn't only building a consumer financial platform. It also owns Galileo, and Galileo is a financial technology infrastructure platform. Here's why that matters. Behind many modern financial products is an enormous amount of technology. Companies need systems for accounts, payments, cards, banking services, financial APIs, data, and other infrastructure. Galileo helps provide some of that technology. SoFi therefore has two potentially powerful engines. One is its consumer financial ecosystem. The other is financial technology infrastructure. That combination makes the company more interesting than a traditional digital bank. And if Galileo continues expanding, SoFi could potentially benefit from growth in fintech even when customers aren't directly using the SoFi consumer brand. That's a very different opportunity. 4. Why digital banking could keep growing. Think about how quickly consumer behavior has changed. A generation ago, opening a bank account usually meant visiting a branch. Today, millions of people expect to do almost everything from a smartphone. Open an account, move money, deposit checks, invest, track spending, apply for credit, and monitor their finances. Convenience has become a competitive advantage. And SoFi was built around that digital behavior. The company doesn't have the same branch network as traditional banks. Instead, it can focus heavily on technology and user experience. That doesn't guarantee success, but it does give SoFi a different cost structure and a different way of building customer relationships. And the opportunity could become even more interesting as artificial intelligence changes financial services. 5. Where AI could enter the story. Artificial intelligence is becoming increasingly important across financial technology. Imagine a financial platform that understands your income patterns, spending behavior, savings goals, investments, and borrowing needs. Instead of simply showing you numbers, the platform could eventually help you make better financial decisions. AI could potentially personalize financial recommendations, automate routine tasks, detect unusual activity, improve customer service, and help companies manage risk. SoFi doesn't need to become an AI company for AI to benefit its business. It simply needs to use AI effectively. That's an important distinction. The future of fintech may not be about having an AI logo. It may be about using AI to make financial services cheaper, faster, smarter, and more personalized. And SoFi is positioned in a market where those improvements could matter. But there is another side to the story. 6. The biggest risk nobody should ignore. SoFi is still a financial company. And financial companies have risks. Interest rates matter. Credit quality matters. Consumer spending matters. Employment matters, and economic conditions matter. If the economy weakens significantly, borrowers may struggle to make payments. That could increase credit losses. And because lending is an important part of SoFi's business, investors need to pay close attention to credit performance. A company can grow rapidly while still running into problems if the quality of its loans deteriorates. That's why revenue growth alone isn't enough. Investors need to ask another question. How profitable is that growth? 7. Growth versus profitability. This is one of the biggest questions surrounding many fintech stocks. Rapid customer growth sounds exciting, but if acquiring those customers costs too much, growth may not create enough value. SoFi needs to show that it can grow efficiently. That means watching metrics such as revenue growth, adjusted profitability, cash flow, customer growth, deposits, and product adoption. If those numbers improve together, the investment case becomes stronger. But if revenue keeps rising while profitability struggles, investors may become less enthusiastic. The ideal scenario is different. SoFi grows its membership. Customers use more products. Deposits increase. Revenue expands. Credit remains healthy, and profitability improves. That's the combination that could create a much stronger financial model over time. 8. The competitive threat. Now let's talk about competition. Because SoFi isn't alone, traditional banks have enormous customer bases. They have established brands. They have large technology budgets. And they already have relationships with millions of consumers. Then there are other fintech companies, digital banks, investment platforms, payment companies, credit providers, and financial technology startups. Some are extremely aggressive. SoFi therefore needs to keep giving customers a reason to stay. The company can't simply offer a digital banking app and assume customers will never leave. The ecosystem needs to become increasingly useful. And that's where cross-selling becomes so important. If a customer uses multiple SoFi products, switching becomes less attractive. The relationship becomes deeper. And deeper relationships can potentially create stronger economics. 9. The bull case for SoFi stock. Now let's imagine everything goes right. SoFi continues adding members. Existing customers adopt more products. Deposits continue growing. Credit performance remains healthy. Galileo expands. Technology becomes more efficient. AI improves customer experience. And profitability continues improving. If that happens, SoFi could evolve from a fast-growing fintech company into a much more mature financial platform. And that could change how investors value the business. The market might eventually see SoFi as more than a digital bank. It could see a combination of consumer finance, technology infrastructure, and financial services. That's the long-term bull case, and it's a compelling one. But there is still one major question. 10. Is SoFi stock too expensive? This is where investors need to slow down. A great company isn't automatically a great investment. Price matters. If investors become extremely optimistic about SoFi, the stock can rise faster than the underlying business. And when expectations become too high, even good results may not be good enough. Imagine SoFi reports strong growth, Revenue increases. Members increase. Profitability improves. But analysts expected even stronger numbers.
The stock could still fall. That's because stock prices are based on expectations about the future,
not simply what happened last quarter. This is why investors should avoid looking at SoFi as a guaranteed winner. Instead, look at the relationship between growth and valuation. If SoFi can keep growing rapidly while improving profitability, the valuation may become easier to justify. If growth slows significantly, however, the same valuation could become a problem. 11. What should investors watch in 2026? There are several numbers I would keep an eye on. First, member growth. Are new customers continuing to arrive? Second, products per member. Are customers using more of SoFi's ecosystem? Third, deposits. Are customers keeping more money inside the platform? Fourth, credit quality. Are loan losses remaining under control? Fifth, profitability. Is the company becoming more efficient as it grows? And finally, Galileo. Is the technology platform becoming a larger and more valuable part of the business? Those metrics can tell you much more than the stock price alone. 12. So, is SoFi stock still worth buying in 2026? Here's my take. SoFi is one of the more interesting fintech stocks to watch in 2026. The company has a recognizable brand. It has a growing digital ecosystem. It has exposure to lending. It has banking and investing services. And it owns financial technology infrastructure through Galileo. That gives it multiple potential growth engines, but I wouldn't treat SoFi as a risk-free investment.
There are real risks: credit losses, economic slowdowns,
interest rate changes, competition, and valuation.
So the question isn't simply, is SoFi a good company? The better question is, can SoFi become significantly larger and more profitable over the next 5 to 10 years than the market currently expects?
If the answer is yes, today's stock price could eventually look much more attractive. If the answer is no, investors could discover that the growth story was already priced into the stock. And that is what makes SoFi so fascinating. The biggest opportunity may not be the banking app.
It may not be the loans. It may not even be Galileo.
The real opportunity could be the combination of all of them.
A single financial ecosystem where customers can save, spend, borrow, invest, and manage their money through one technology-driven platform.
If SoFi can make that ecosystem genuinely difficult to replace, the company could become a much bigger player in financial services. But investors shouldn't buy the dream alone. Watch the numbers. Watch profitability. Watch credit quality. Watch customer engagement. And watch valuation. Because the difference between a great stock and a great company can sometimes be enormous. So, is SoFi stock still worth buying in 2026? I think it deserves serious attention. But whether it's a buy today depends heavily on the price you're paying and your tolerance for volatility. And perhaps the most interesting question isn't where SoFi is today. It's where this company could be 5 years from now if its financial ecosystem strategy actually works. Because sometimes the biggest investment opportunities aren't the companies trying to disrupt one industry. They're the companies trying to connect several industries together. And SoFi may be attempting exactly that.